I'm Daniela Cambone for Kitco News, and you are watching In the Lead for the week of April 11th. Good morning, Jon.
Good morning, Daniela.
Jon, first big news of the day, China reporting its first quarterly trade deficit in 7 years. Your thoughts?
The news actually reflects primarily the gain in commodity prices, and imports surged actually on the back of higher oil prices. This is filtering into almost all aspects of life now. What's interesting about it is that imports and exports both surged, and they still remain quite robust, despite indications earlier that the Chinese government would like to experience a bit of a slowdown economically this year. At the end of the day, the inflation combat is really what's on Premier Wen's agenda. And of course, a 5.25% rise in consumer prices in March is not exactly desirable. So they will continue to roll on with their program of tightening, raising reserve requirements among lenders, and probably ratcheting interest rates higher. We just noted a quarter-point hike last week, and I think the trend is basically going to remain the same for the remainder of the year, as long as inflation numbers continue to be above the 4% target that the government would like to see.
Jon, as you mentioned, China's imports and exports both surged, so this must mean good news for the base metals, I would assume?
Well, actually, it seems that copper is reacting to news that it may be in a surplus situation just at the moment. We've also seen that oil prices were the primary driver behind such gains. Clearly, we have to see how the economy continues to roll on this year, because basically, if you look at the platinum group metals complex this morning, speculators took quite some bit of money off the table, specifically because news from the Chinese Auto Manufacturers Association was that car sales in March came in significantly below expectations after government subsidies expired and after incentives were removed from car buyers. So the slowdown that is desired by the Chinese government could in fact spread and actually become manifest as the year rolls on. On that basis, I think we have to be a bit cautious and see how the demand for base and precious metals continues to give us statistics as we go into the second half of the year. It's not a sure bet as yet.
And just as our last point on China, Soros went on the record saying that China may lose control of inflation. Do you agree with this?
I'm not so sure about losing control of inflation as much as perhaps having to actively combat it with more than just interest rate hikes. Certainly, you could put clamps on real estate speculation and similar moves that could, in fact, undermine the very strong speculation we've seen in the country, which then resulted, of course, in higher inflation and the potential for social unrest. This is really what the government is focusing on. Any type of social unrest, such as we've seen in Middle East, North Africa, in the wake of difficult economic conditions, is not something that the Chinese government is willing and able to accept.
So, Jon, still on the subject of the D word, Obama is set to propose a long-term plan to reduce the deficit. What could this mean for the U.S. dollar?
Well, you noted last week that the impact on the dollar of the imminent government shutdown in D.C. was pretty negative. Obviously, currency traders were all apprehensive about the fact that, the government shutting down could undermine the dollar's desirability, and we saw that reflected in fairly sizable losses in the greenback last week, as well as robust gains in precious metals. So now the inverse situation might be at hand, because obviously after much wrangling and after avoiding the last-minute shutdown, the resolve is now on to cut some more. President Obama will be addressing the nation on Wednesday, and he is indeed coming to the podium with specific measures designed to cut certainly from entitlement programs as well, which were regarded as sort of a sacred cow before. And he will propose not only specific areas for the scalpel to be taken out against, but also specific timelines by which to carry out such cuts. So anything in terms of cutting is potentially dollar beneficial because the world obviously likes to see the U.S. address its federal deficit. And I think the other thing that our viewers might want to focus on going forward is the imminent deadline to potentially raise the debt ceiling in the U.S., without which we would de facto have a default. So that's another deadline to watch, just as important as was last week's deadline about the government shutdown. But overall, I think that the budget cutting measures will prove to be dollar beneficial in the long run.
Okay, Jon, and finally, the IMF has lowered its forecast for the U.S. amid rising commodity prices. It has also lowered its forecast for Japan, mostly due to the earthquake. And as a result, we saw crude oil prices drop this morning. Are you surprised?
Not really. I think it's basically a question of the chicken and the egg, did the IMF cut its forecast for U.S. and Japanese growth specifically because it saw oil prices getting out of hand, or did it in fact just take into account the fact that the Japanese catastrophe will result in a shaving of at least some percentages off of that country's GDP? It is said that the cost of the event will amount to perhaps 3 to 5% of GDP. Now, the fact that the IMF did temper its forecast for growth for the US and Japan does not mean that it has cut its forecast for global growth patterns. It still sees a decent pattern unfolding around the world this year, and it thinks that the worst is behind us as far as the contractive phase of the economies globally. And that said, I think it does underscore the fact that oil prices are not based on fundamentals of supply and demand at this moment, and it is concerned, the IMF is concerned about the potential threat, not only of a double dip, but of the threat that oil prices pose to the global economy, not just that of US and Japan.
So overall, Jon, it should prove to be a very exciting week.
Indeed, I think volatility will continue to be manifest here. That there's a battle, shaping up between the profit takers and the speculators. We've seen CFTC data corroborating the fact that net speculative length in gold and silver and platinum and palladium has risen for the third week in a row. But at the same time, other analysts at Commerzbank and Standard Bank note that, as well as Elliott Wave, by the way, note that with 93% bullishness in gold and 96% bullishness in silver, we might want to be a little bit cautious and be on the defensive to watch for quick exits by speculators in this niche on occasion. I mean, obviously not a establishment of a new trend, but we have to be careful on an intraday basis because outsized moves could very well play into this market during the coming days and hours.
All right, Jon, thank you so much. We'll see you again next Monday for a new edition of In the Lead.
Indeed, we will.